Welcome everyone to the Bell Asset Management webinar, Global Equities, a Game Plan for Managing Volatility. My name is James Diggins and I'm a Distribution Director at Channel Capital. We are the distribution partner for Bell Asset Management. Bell Asset Management is a global equities manager based in Melbourne and offers two global equity strategies through its quality at a reasonable price style. The Bell Global Equities Fund, a large cap strategy, and the Bell Global Emerging Companies Fund, a small and mid-cap strategy, have both delivered strong returns for investors over time. Today, I'm joined by Ned Bell, CIO of Bell Asset Management, and Joel Connell, Senior Global Equities Analyst, to talk further on what to expect from the first full quarter of COVID-affected corporate earnings, specifically within the small and mid-cap universe. A brief background on Ned and Joel. Ned has over 20 years of investment management experience and is primarily responsible for the overall return outcomes of client portfolios, providing investment leadership. Ned's primary research coverage responsibilities include the materials and telecommunications sectors and secondary responsibilities over industrials and healthcare sector stocks. Joel has worked alongside Ned for 13 years at Bell Asset Management. Joel has primary research coverage responsibilities across healthcare, consumer staple sectors, and secondary responsibilities in the financial sector across the cap size spectrum in developed and emerging markets. Joel is also responsible for the trade execution function. Speaking to many advisors in the market, we often hear concerns about overexposure to global growth stocks and extreme valuations. We believe the current environment makes a good case for an allocation to global small and mid-cap stocks for client portfolios due to a few reasons. One being the strong potential growth opportunity. Two, less valuation risk than other growth assets. Three, diversification. Also, business class cycle sweet spot at the moment, which Ned will cover off in more detail. And there's also a lack of analyst coverage and investor intention. The investment team at Bell Asset Management has a unique way of defining the mid-cap universe, which differs from the MSCI World Mid-Cap Index. It does this by applying a minimum market cap size of $1 billion, a return on equity of 15% or greater for 3 consecutive years, a quality score, and a quality test. By defining the universe and applying these filters, clients get exposure to an investment solution that has delivered top quartile returns with a low risk profile. The webinar will run till about 1:15 p.m. and if you can submit your questions throughout the presentation with the Q&A box down below. We'll try to cover all of your questions, and if we don't get to them, one of my colleagues will follow up with you post the webinar. So now, Ned, turning to you and looking at valuations, there's always been a lot of focus on valuations in equity markets. And with recent commentary around the extremes in market valuations that we are seeing globally, especially in the US, with most of the focus around large cap equities, how does that correlate with the small and mid cap end of the market?
Yeah, it's a great question, James, and thanks everyone for joining. So again, valuations, it is obviously a very hot topic, and I think I'd make a couple of points, but when we look at global equities as a whole, so the MSCI World Index as a proxy, valuations as a whole, they're not that bad. The forward PE is about 20 times earnings. So in other words, an earnings yield of about 5%. So in the context of effectively zero interest rate environment, 5% earnings yield is not that bad. But then within that, there is massive dispersion from a valuation perspective. So again, coming back to that idea of and probably the biggest dispersion is the dispersion between large cap growth and value stocks. So, when you think about like the MSCI World Growth Index, for example, is trading on a current year PE about 29 times, which is a 45% premium to the market. The value end of the market's trading on about 15 times earnings, which is a 25% discount. So the jaws, if you like, between value and growth are pretty huge. And then when you dig down further into, especially the IT names, and needless to say, some of the valuations in some of those large cap names have become somewhat unhinged from fundamental reality. There's been just massive amounts of momentum driving those stocks higher for the reasons we all know. And so there is a lot of dispersion there. But then when you get into, I guess from the style lane that we drive within, if you like, the quality sector. So quality names, that they're only trading on a PE premium of about 10% to the market, which is actually not that bad. And I think this is interesting because a lot of people think quality and growth are one and the same, but they're not really. Like from our perspective, quality is more about it's the sustainable profitability of the companies, but also the balance sheet strength. So those companies there's still decent value. But I think when you get into the small mid-cap space, and this is where there is, in our view, still a pretty good opportunity from a valuation perspective. Yes, these stocks, they've had a bounce off their lows, but in a relative sense, the valuations are still pretty attractive. So the MSCI World or the global small mid-cap stocks trades on a forward P of about 19 times, which is a pretty big discount to the MSCI World Growth Index. So again, that discount is pretty compelling. And I think the way we tend to think about it is as we move through the COVID crisis, when things start to calm down a bit and you start to get that earnings inflection on the up, you will see that re-rating and that gap will close, and that does represent one of the pretty interesting opportunities from our perspective. So yeah, we think that, and just one last point on that, you also need to think about where have the small mid-cap stocks come from in the last couple of years. And the reality is, the first point on that slide, they have lagged. They've lagged by about 4% per annum over the last 3 years. So looking at this asset class now, you're not buying something at the top. You're buying something that has not quite kept up, but the underlying fundamentals are still very, very good.
Perfect. And then I guess turning to kind of earnings, we're starting to see companies report their first full quarter of COVID-affected earnings.
Yeah.
It'd be interesting to get your thoughts on what you're expecting from this, both negative and positive, and, how you're positioning the portfolio for defence, and also, what opportunities are there for investors?
Yeah, sure. So I think I'll answer the first. So the first question, the last question first. So in terms of portfolio positioning, so in terms of how we're positioning the fund, the SMID Cap fund, look, there's a couple of key points. First of all, we've got obviously a very big quality bias, which we'll touch on a bit more. Secondly, within the small mid universe, we're probably a bit more overweight those mid cap stocks, because mainly we're seeing a bit better relative valuation, a bit less short to medium term earnings risk. And then from a sector perspective, we're pretty overweight things like healthcare and consumer staples. And that's not so much a case of just being defensive. We're actually finding good growth companies, and Joel probably will touch on them, but we're finding good money making opportunities there now, which I think is really important. In terms of, and then where we're very underweight, I think the more cyclical sectors, so things like financials, industrials, and real estate, that's where we've got much less exposure. When it comes to earnings season, it's going to be a bit of an eye opener, I think. And to your point, this is really going to be the first quarter of basically full COVID conditions. So it's going to be somewhat probably confronting. But having said that, the reality is that the current year earnings estimates have been downgraded very materially. So the MSCI World current year estimates are down about 34%. Small mid caps are down 39%. So they have been savaged, if you like. And I think the way we tend to think about it is the current year estimates are probably fairly reflective of what we're going to see for the whole year. In terms of what the company's going to start talking about, I think we'll probably see a bit more in the way of more subdued commentary around specifically the reopening of the US economy. I think investors maybe got ahead of themselves about how quickly the reopening will happen. Everyone's seen the recent COVID cases in the US that, they've gone from bad to worse, unfortunately. So I think there needs to be some expectations just tempered a little bit, and you'll probably see that. And you saw that a little bit from some of the bank execs last week when they announced their earnings, and you saw, I think it was Wells, Citi, and JP Morgan. I think their collective loan loss provisions were about 28 billion US. So that is somewhat of a forward-looking perspective around, how the economy is going to play out. I think we'll also see more in the way of cost management initiatives. There has to be some staff layoffs, unfortunately. That's kind of just a bit of a reality that will unfold. And then probably one of the bigger things we're keeping an eye on is the fact that the 2021 EPS estimates for the market as a whole, they're too high. There's been some downgrades, but it's usually around this time of year when companies are announcing their earnings, they start looking forward a little bit. They look beyond the end of their shoes and they're thinking about, okay, how quickly the earnings are going to recover. And current estimates for next year would imply that global earnings will probably rally 20-25%, which just doesn't seem that likely. So that's probably one of the risks we're keeping a bit of an eye on.
Great, thanks, Ned. And Joel, turning to you, I think we might look to maybe dive into some stocks. And, you know, I guess the one question that has been coming thick and fast is, I guess, against the backdrop of COVID-19, can you talk about some of the implications for that healthcare and consumer staple names, you know, in the portfolio?
Yeah, sure. Yeah, sure, James. Maybe I'll just start with healthcare. You can see there we've got over 20% of our portfolio in healthcare-related stocks. It is an area where we have been able to find a lot of great alpha-generating opportunities historically. There are plenty of positive long-term structural drivers for the industry. But when we're thinking about the implications from a COVID perspective, it's probably worthwhile just breaking things down into a few of the sub-segments, because there are quite a few different nuances to understand for each company. So, for example, within our mid-cap portfolio, one area we have exposure to is the growth in R&D spending by pharma and biotech companies. So we have a couple of holdings in contract research organisations called Icon and Charles River. So these companies basically partner with the pharma and biotech companies to conduct a lot of the work associated with discovering new drug molecules and running the clinical trials. So they ultimately benefit from increased R&D spend. From a COVID perspective, we did see a brief pause in some of the clinical trial activity during the second quarter, but we do expect a strong rebound and believe that the longer term trends remain very positive. Now, one aspect of this economic contraction that is different to past downturns is that it's been driven, as we know, by a health crisis. So this really means that we're seeing even more investment go into the drug and vaccine discovery space than ever before. And I've seen recent data has shown that in the June quarter, it was by far the highest ever quarter on record for biotech funding. So we think that bodes well for continued R&D investment in the space. And we think that companies like Icon and Charles River are well placed to capitalise on that. One of the other sub-segments that we have exposure to is animal health. So we have a position in a company called IDEX Labs. So they're the global leader in animal health diagnostics. So we see the pet care space in particular as being, seeing relatively limited short-term impact from COVID. And in fact, the long-term drivers remain very favourable, driven by the positive pet ownership trends. So people are obviously spending more time at home. Pets are going to be becoming even more and more important parts of many families. I know anecdotally, I've lost count of the number of friends who have bought a new dog or pet into their home over the last few months. So we continue to believe that the dynamics in the animal health space remain very attractive. And then I guess one of the sub-segments which has probably experienced a bit more of a negative impact in the short term is the dental or orthodontic space. So we saw many dental clinics around the world either closed or only doing emergency work during much of the June quarter. And so this is going to weigh quite heavily on the near-term earnings of many dental-related companies. But we do expect a fairly sharp recovery as the dental clinics reopen. And we do still think there are some excellent structural growth stories, like Align Technology, which we own in the portfolio. So Align is the dominant market leader in clear aligners with the Invisalign brand. And they've still got a really big addressable market as they penetrate and take share from wires and brackets. So this year is certainly going to be very weak for Align, but we expect a strong recovery next year. And we think they're going to emerge even stronger, in an even stronger competitive position in a post-COVID world, because they've got a very strong net cash balance sheet, and they've continued to invest through the downturn. So that maybe just covers a few of the headwinds and tailwinds on the healthcare side. We think overall in healthcare, we're positioned very well, regardless of how the external environment plays out. And then maybe just quickly on the consumer staples side, we have holdings like US food retailer Kroger, consumer goods manufacturer Church & Dwight. So they've benefited from the pantry stocking trends and the work from home trend. And these types of stocks in consumer staples, they offer much more resilient earnings. They can play somewhat of a counter-cyclical role in the portfolio. And we think they offer really good downside protection when the market has a sell-off like we saw earlier this year. So maybe I'll stop there. Happy to drill into any more specifics, but that's a bit of a brief rundown.
Yeah, perfect. Thanks, Joel. And you did touch on a few companies that have seen, some of that benefit in the post-COVID world, but is there one company in particular you would flag as being a structural beneficiary of that kind of what's happened with COVID?
Yeah, I mean, there's one company I actually didn't mention before, but in the healthcare space, there's a company called Ambu. So they're a mid-cap Danish listed medical device company. So we see them benefiting both, from increased demand in the short term and also in the long term. So maybe I'll just touch quickly on what they do for those people less familiar with the company, just to provide some context as to why we see them as a beneficiary. So Ambu produces a range of different patient monitoring and diagnostic products. And the key growth driver is their portfolio of single-use endoscopes. So these are scopes that are used by doctors or surgeons to see inside a patient's body. And they're used in a range of different procedures, like a bronchoscopy, where the lungs are examined, or a colonoscopy, which is used to look for cancers or other abnormalities within the bowel. So currently there's around 100 million endoscopy procedures performed globally each year. And at the moment, the overwhelming majority of procedures are done using reusable scopes. But the big issue with those reusable scopes is that there's risk of contamination or infection if they're not cleaned or sterilized properly, which unfortunately happens much more than you would expect. So Ambu's single-use scopes basically eliminate that risk of infection, which is obviously great from a patient health perspective. And it also reduces the risk of litigation for the hospitals. So we expect Ambu's single-use scopes to take significant share from reusable scopes over the next 5 to 10 years. In terms of why Ambu is benefiting from the COVID pandemic, so firstly, in the near term, Ambu's single-use bronchoscopes, they're actually being used to diagnose the condition of COVID-19 patients, particularly in the European markets. So this has actually led to a big spike in demand in the short term, and that's actually driven a recent upgrade to Ambu's guidance for this year. And then from a longer term perspective, we see further acceleration in that shift from reusable to single-use scopes, given the heightened concerns around infection control. So I'll just put a couple of numbers around the massive market opportunity that they've got. So the single-use market at the moment is around $500 million in size. And Ambu management estimate this could grow to $2.5 billion by 2024. So that's a 5-fold increase. And we think that's very achievable based on the work that we've done. Now, in terms of how that potentially translates into Ambu's earnings prospects, so looking out to 2025, we think the company could potentially deliver earnings that are 7 times higher than what Ambu will deliver this year. So that's going to be driven by the very strong organic top line growth as the single-use scopes take share. And the company's also set to launch at least 15 new single-use products over the next few years. And we also expect significant margin expansion from the current compressed levels. So we've actually been investors in Ambu since 2016, and the stock has been a great investment for us so far, but we do still think they've got a really big growth opportunity ahead, and that's only been strengthened by the COVID pandemic.
Fantastic. And then I guess one last for Joel, just to maybe touch on, is that, we've seen a lot of volatility in the first half. Did that present you and the team with any new names in the portfolio that you wanted to own but couldn't get there on either on an earnings or a valuation basis?
Yeah, I mean, absolutely. We had some really fantastic opportunities, particularly towards the end of the first quarter. We saw a lot of indiscriminate selling, I guess you could say, across the market. And so this meant that the valuations of some of those really great quality business became a lot more attractive. One good example is actually a company I touched on earlier, IDEX Labs. As I said, they're the market leader in animal health diagnostics. So may not be a household name that many people would have heard of, but if you have a pet that you've taken to the vet for some type of diagnostic test, then there's a high likelihood that IDEX's platform played a role in that test. So they are over 3 times the size of the next 3 largest competitors combined, and make up more than 80% of industry R&D spend. So they're in a very strong competitive position. And like I mentioned earlier, they have some great structural drivers in terms of the pet ownership trends, which we think bode really well for continued long-term growth. So IDEX was a company that we've been following for many years. We'd engaged with the management team on many occasions, and we really built up that conviction in the quality of the company and the long-term growth opportunity. But the valuation was always a sticking point. And then during the March sell-off, the stock actually pulled back about 40%, and it really did give us a great entry point. So we established a position in late March, I think under $190. I think the stock now is over $350 or $360. So it's up over 80 or 90%. So it's been a good investment. That's just one example. There were a few other names that we got great opportunities to invest in, like Straumann, which is a Swiss dental implant manufacturer, Yeti, which is an outdoor lifestyle brand, and CHR Hansen as well, which is a Danish producer of cultures, enzymes, and probiotics. So they've all been really good investments so far because, I guess we were opportunistic about the timing of getting in, and we got some great opportunities. And that's really, as active investors, that's what we love getting. We don't like seeing markets go down, but we have a high quality watch list that we're ready to pounce on quickly when we get those opportunities.
Great, thank you. And maybe, Ned, turning to you, as you seek to find these, hidden gems that are in the sweet spot of their business cycle, that probably can show greater prospects for growth and earnings than probably the larger end of the market. How do you avoid the bad investment decisions? And can you kind of share some of those examples?
Yeah, it's a good question. And I think particularly when it comes to getting into the small mid-cap space, because there is a massive divergence between high quality and low quality stocks in this particular space. And frankly, from our perspective, the best way to avoid making mistakes is to basically only invest in the high quality businesses, because they're the only ones you realistically need to, and they're the ones that are going to compound earnings more consistently over a long period of time. And then secondly, you just got to be a bit more disciplined on valuation risk. And so I think that's where, in terms of how we approach this, is we tend to, first of all, we've got a very high quality bar. So we only focus on about 150 companies that are investable globally, and that doesn't change very much. So getting to know those companies really well over a long period of time basically means that you are far less likely to make mistakes than if you are willing to just invest in anything that comes along. Like, you've got to do the work and build theses on companies over a long period of time. So I think, those are the two broad things. And I think, just bringing that question back to this slide, I think one of the points I'd make here is, if you look at the companies on this slide, this is the creme de la creme of global small mid-cap investing. Like, these are fantastic companies. They've got very high quality franchises that are quite unique. Really importantly, they've got good organic growth characteristics. And I think that's what's important, because you need to, especially when markets have done what they've done recently, you need to strip back your portfolio and think about, where is your growth coming from? And is there a sensible way to diversify your growth exposure? And I think when we think about these companies, within the small mid-cap universe, they're companies that they're a bit better established. They've been around a bit longer. They're generating free cash. They've got good balance sheets, so they're not reliant on capital markets. And that's really important, because, we see this every single day. We're seeing, just one horror story after another about small mid-cap companies. They're drawing down credit lines. They're doing emergency capital raisings. That's happening day in, day out. And we're in the first innings of that. So that's still got a long way to play out. We just don't have any exposure there at all. And you just don't need to be there. And then you think about these companies, and even now, we've been getting questions about, are we still finding opportunities now, having, given what markets have done in terms of the rebound? And if you think about the, in terms of some of the more interesting opportunities, now we have been finding these great opportunities. So for example, since the end of May, we've introduced positions in stocks like Hershey, Booz Allen, Toro, Zebra Technologies. And so those companies, for example, as a whole, those companies, we see about 35, 36% upside on those on average over the next 12 to 18 months. They trade an average PE of about 23 times earnings, return on capital about 21%, and their long-term growth forecasts are around 12%. So there's some really interesting opportunities that are still there. And I think that's what's really encouraging. And then if you look at can we just flick to the next page? and this is a very good representation of the magnitude of quality in the portfolio, and then B, what are we paying for these sorts of companies? So if you think about the like quality at a reasonable price in this space, the reality is, like our portfolio, the magnitude of return on equity and return on capital is extremely high. The net debt to EBITDA much lower. The growth metrics down the bottom there. So again, the companies we've got, I mean, they've grown their earnings at 15% annually. So the point being that you don't need to just own the large cap tech stocks for growth. You can get down into the weeds of small mid cap and find some terrific businesses that are growing really well organically. And I think that's what's really important, because as much as they're obviously not going to grow at that sort of clip this year, but once we come out the other side of COVID, I think what we'll find is those organic growth drivers, they will come back. And these high quality companies are the ones that are going to rebound fastest. And I think that's what's really important. I think the other point I'd sort of make is that, just on that slide there, you can see that the top right there, that the average market cap of the portfolio is actually, it's a little bit higher. And this comes back to your earlier point around how we define small mid cap, but around 14 billion US. So as much as we'll invest down to 1 billion, we've got this terrific flexibility where we can go up the market cap spectrum when we feel the need to. And I think that's a pretty big advantage that we've got, which is a good one to point out, I think.
Thanks, Ned. And then Joel, just one more from the audience. It's just they've asked that, can you talk through, I guess to Ned's point around, getting into the weeds, can you talk us through the thesis behind one of your high conviction ideas and, in its mid portfolio, and why expect them to outperform over time?
Yeah, sure. Happy to, James. I think in the current environment where there is obviously still a great deal of macro uncertainty and also pockets of extreme valuations, as we've spoken about, I mean, I think one of the companies we still think is being mispriced is US food retailer Kroger. So they're one of the largest food retailers in the US. For our Australian clients, just think a company like Coles or Woolies. So yeah, we initiated our position initially in Kroger, I think in July last year. At that time, we identified a number of catalysts, and the stock was also trading at a very attractive valuation. I think it was just under 10 times PE and close to 10% free cash flow yield. So obviously since then, the COVID outbreak has led to a significant short-term boost from pantry stocking as lockdown measures took hold. But we know that sort of benefit's not going to last forever. But we do expect an incremental shift back in favour of at-home food consumption. And we think we'll likely see more working from home, less travel, and potentially even less propensity to dine out in a post-COVID world. So that benefit wasn't necessarily part of our initial thesis, but we think it helps to strengthen the case further. Maybe I'll just touch on a couple of the things that we think maybe the market's missing or not giving Kroger much credit for. If we roll back the clock a few years, the company launched a new growth transformation plan back in 2017. And since then, they've seen a little bit of disruption just around things like their store layouts, product assortments, and they've really stepped up their investments in their omni-channel capabilities. So this has put a bit of pressure on revenue growth, free cash flow and margins. But we think the company is now sort of through the bulk of that pain, and we think they're set up to see improving same-store sales and free cash flow moving forward. And a big driver of a lot of these decisions that Kroger's been making comes from the data they're collecting. So they're actually collecting more data on food purchases than just about any other company in the US. They've got a really strong loyalty program, which that captures data on more than 96% of the 3 billion plus transactions they have every year. And this really enables them to provide more personalized experiences for the customers. And we're also starting to see Kroger monetize that data. So they're selling those insights back to the CPG companies. And we're still in the early innings of that monetization. And yeah, we think that Kroger's scale, so they're generating well over $100 billion in sales every year. And the company's private label offering gives them really good bargaining power with the branded manufacturers. So they're getting nearly 30% of sales from their own brand products at the moment. And they've continued to innovate in that space. Now, I guess one question often we get is from a competition standpoint, and there's no doubt that the food retailing is a competitive industry, but we think the competitive fears are overdone. We think food retail is much less of a winner-take-all type market. We think there's room for multiple players to be successful, and we think stronger players like Kroger, Walmart, Costco, and even Amazon following their acquisition of Whole Foods, we think they'll continue to take share from a lot of the smaller regional companies that, you know, perhaps have far less capital to invest and haven't been able to keep up in a more omni-channel environment. So, and then when you tie all of that up into valuation or what you're paying for the stock, we think the valuation continues to look compelling. The stock's trading at about 12.5 times forward PE ratio, which it's about a 40% discount to the broader market. Historically, it's traded at roughly 10 to 15% discount on average. And then you look at peers like Walmart, they're trading on 25 times. Even the Aussie food retailers, Coles and Woolies, they're on at least mid-20 PE ratios as well. So we're not predicating our investment case on Kroger re-rating to those types of levels, but we think as the company delivers more improved performance over the next 12 or 18 months, there is room for at least a few PE points of multiple expansion. And then when you factor in the 2% dividend yield, we're projecting high single-digit, low double-digit compounding shareholder returns, along with that potential for an extra 20% plus upside to come from multiple re-ratings. So that's a name, I guess, in the current environment where, yeah, maybe there are some stretched valuations or a little bit of earnings downside risk that still exists. We think Kroger's got a really good combination of upside potential and downside protection. So I'd say that would be one of our conviction names, and it's actually our biggest position as at the end of June as well.
And it'd be amiss of me not to mention that I think a famous investor globally, Warren Buffett, might have made an investment into Kroger. Did they do it before you, or did you get in before the great Berkshire Hathaway?
Yeah, I think technically he followed us in. I don't know. Maybe he's been reading our monthly reports. I'm not too sure. I think they came in sometime in the fourth quarter last year. I don't have the exact date, but we bought in July of last year, and I think their initial entry price was somewhere around $26, $27, and ours was, I think, under 22. But I mean, certainly when any time a successful investor like that buys a holding that you've got, we think it's good validation. So I guess they probably just saw the good long-term value that we saw.
Fantastic. Well, pardon the pun, but that's that you're in good company there. Now, Ned, the last kind of formal question we have, and then there's more questions coming from the audience, which is great, is that I guess some people, when we go out and talk to them, kind of think about how does SMID fit into a portfolio in a construction context. So it'd be kind of great to get your idea explained to the audience about how to think about a SMID allocation, and does it help improve that risk return characteristics, on the global equity side of things?
Yep. No, it's a great question, and I think I think the other thing is around the timing too, because it does sound somewhat counterintuitive to be recommending allocations to small mid-cap stocks at a point when earnings are troughing. But history would basically suggest that is actually the perfect time to be allocating to this asset class. So, but just coming back to the question around improving, I guess, the risk return profiles of global equity portfolios and how SMID can fit into that. I think from a very high level, the way we think about it is that, again, you've got to think about small mid cap as playing a growth role in your portfolio. So think about it in the context of being a complementary allocation alongside, say, large cap growth, emerging markets, even Aussie small caps, which are obviously extremely expensive. So that's kind of the 3 or 4 sort of legs of the growth stool. So, first of all, the thing that still amazes us is a lot of institutional investors and retail investors, they've just got almost no allocation to this asset class, which to us represents a massive opportunity. But I think, again, thinking about it versus those other growth proxies, look, an allocation to small mid cap, it definitely reduces your valuation risk if you're taking profit from large cap growth and you're funding an allocation that way. I think you do need to think about it versus things like emerging markets, and emerging markets haven't been talked about nearly as much more recently. But the sad reality is that the emerging market countries they really are feeling the brunt of the COVID pandemic. Not only from the context of the global macro backdrop, which is clearly pretty horrendous, but just through the sheer case numbers through a lot of those countries is pretty terrible. So it does. So in terms of comparing SMID cap equities to emerging markets, it arguably reduces your earnings risk somewhat. And then also from a sector perspective, also it's probably fair to say that I think a lot of investors, one of the dilemmas they've got now, or observations they have now when they look at their portfolios, is that they've got huge exposure to IT stocks, and there's nothing wrong with them. I mean, we think there are some terrific IT companies, but just by virtue of their performance, they now represent, generally speaking, much larger proportions of portfolios than was the case 2 or 3 years ago. And again, I think this is kind of one of the questions a lot of investors are asking themselves is how can I get growth that isn't just a like-for-like proxy over and above what I've got in the large cap world. And that's where small mid cap can play that role. We talked about earlier, we're finding great growing companies in the healthcare space, in areas of consumer discretionary. So there is a very good complementary sector argument to be made here, we think, for making an allocation. And then just coming back to this slide and this whole idea about timing, I think we did some analysis and we looked at 2 of the last big earnings drawdowns in global small mid-cap equities. And the one on the left represents, what happened after the dot-com boom in the early 2000s. Obviously very different, but that was where we did see a big earnings drawdown, and then post-GFC. And then how did those asset classes perform in the subsequent 1, 3, and 5 years? And the point being is that small mid-cap stocks, they generated some absolutely phenomenal absolute performance in the subsequent 5-year period, but also relative performance, but particularly versus like those large cap growth stocks. So you can see in the post.com period, small mid cap was up 221% versus 131% for large cap growth. Now, think about that in the context of portfolio positioning, and as I referenced before, most people are very overweight in that grey bar, very underweight in the green bar. So, and then the same thing happened in the GFC. And so it comes back to why is that the case? And I think one of the points that needs to be taken into account is it really comes back to the earnings leverage in these small mid cap companies. So when you go through these big economic contractions, the companies, by their very nature, they have to cut their costs back to a like-sized, back to the point where they can cope with what's happening economically. And obviously that's pretty challenging at the moment. But for the ones that can hold their breath long enough and see it through to the other side of COVID, when the stimulus hits the economy, and you see, for example, in the US, when the doors fly open for the US consumer, the earnings leverage is absolutely massive. And that's what we're expecting to see in the next 3, 4, 5 years. And we don't know when the earnings recovery is going to be. No one does. But when it does happen, there will be huge earnings leverage that will have a much bigger impact on the small mid-cap space than probably the large cap space. And then over and above that, coming back to my previous point around valuations, if you buy into the argument that the valuations could easily mean revert at the same time as this earnings inflection, then there's a very, very positive case that the asset class will go through a period of quite amazing outperformance. So I think that's just sort of a bit of perspective around how we're thinking about markets. And again, for investors who look at this space, you need to differentiate between quality, value, growth, because again, there is risk within this asset class, there's no doubt about it. But I think from our perspective, adopting this quality approach is a much better, it's a safe pair of hands type way of investing in this space. And there's just no need to be trying to basically go dumpster diving in the value end, because it's just, the companies are just very challenged and it's not going to get better anytime soon.
Thanks, Ned. And then I guess I've actually got a question here from Melissa, just wanting to know how important ES and G is in your investment approach, and if you could just touch on that, if you could.
Yeah. So the short answer is ESG is very important in terms of how we invest. It's always been integrated into our quality score that you referenced earlier. So there are 6 basically ingredients, one of which is ESG. So we do a number of things there, but we obviously engage with the companies pretty extensively on ESG specific issues. If there are particular issues or concerns, we simply just won't invest in those companies. And the way we think about it, it is very integrated. It's not separate. So, and that's a big differentiator. And while we wouldn't claim to be impact investors per se, we do think that companies need to take ESG issues incredibly importantly. And I mean, some of the stocks we're investing in, especially in this portfolio, but for example, companies like Hershey I referenced before. But one of the most important things we did before reinvesting in that company was to drill down on some of the social issues, particularly in regard to sourcing. So it's something that the analysts and the PMs, we get our hands dirty. We get right into the weeds in terms of the ESG issues. We obviously use some external providers, but we reserve the right to basically form our own opinion. And all the strategies we've got have got ESG scores according to MSCI, which are over and above that of the benchmark. And the one last point I'd make, which is an important one, is that the carbon footprint of our portfolios are very, very low. And they're across all the strategies, they are more than 85% lower than that of the broader benchmarks. So it is something that's quite well integrated into how we go about investing.
And I think that's also reflected in a few Morningstar examples as well when they're looking at your portfolio. So they screen up really well on that front. I've got one from Adam as well, which he just kind of, and I think it refers back to the last chart you had, but do you feel that some investors might feel that they've missed out the boat or missed the boat getting into this asset class? Have you just got any further comments around, the potentials that you see in this asset class, in the SMID asset class?
Yep, so it's a good question. So the short answer is you've not missed the boat. As much as stocks have rebounded off their lows, the reality is small mid-cap stocks have basically gone sideways for 2.5 years. As an asset class, they're basically back to where they were in around August, October 2017. So you've not missed the boat. From a valuation perspective, the valuation, like one of the things we look at is how, to what degree valuation multiples have expanded over and above their 5-year averages. So in the case of SMID stocks, they're only trading on about 8% premium to their 5-year average. And again, large cap growth stocks on 35% premium. So from a valuation perspective, no. In an absolute sense, again, they've drifted sideways. And to my earlier point, the earnings leverage that I've talked about before, that hasn't played out in any way, shape or form yet. We're still in the first innings on that. And I think, there's going to be a bit more volatility in the second half of this year. And that will as Joel, I think, referenced before, that will most likely precipitate more and more buying opportunities for us to pick up some of these, really, really high quality companies. So the ones we don't own, but they're on our watch list, you could easily see a couple of earnings slip ups and stocks get oversold. And we're frankly expecting that. But again, that's a good thing for us because that gives us a great opportunity to pick them up. So absolutely not. You haven't missed the boat at all.
Fantastic. And this might be the last one just in interest of time, but we've got a question here from Ben just wanting to know the engagement with management of these companies is obviously pretty important to your investment approach. How have you been able to cope during this COVID period, and how's the engagement levels been with these companies that you're investing with?
Sure. I'll make a couple of points and I'll ask Joel to chime in too. But the short answer is it hasn't been a problem. So we've had no issues at all engaging with companies. I think importantly, I should note that because we've been doing this for such a long time, we've got to know these companies extremely well. I mentioned before that there's 150 companies in the small mid-cap space which are investable for us, most of them of which we've been following for at least 5, 6, 7 years. And in many cases, we we get to know a company well, and then we wait on them, and it might take 3 or 4 years before we get that buying opportunity. So we have built, and again, pre-COVID, we were doing 500 research engagements a year. So we're wearing out a lot of shoe leather, spending a lot of time on the road. So that's prepared us very, very well for what we're going through now, where our engagement and the way we look at our theses now, it's more about tweaking existing views rather than trying to form brand new perspectives on companies we've just got to know. So I suppose the main points I'd make. Joel, is there anything else there you think is worth mentioning?
Pretty well. I mean, just to throw a couple of examples there. I mean, IDEX Lab, like I mentioned earlier, we bought that in the first quarter of this year, but I think our first meeting with them stems back to 2011, and then we've met them numerous times since then. And CHR Hansen, similar story, bought that in the first quarter, but we've had members of our investment team have had multiple meetings with them over the past decade. I think I remember a meeting that you and I had, Ned, back in 2016 or 2017 in Copenhagen. So yeah, we've, as you said, we've met with these companies many times in person, and it's been a pretty seamless transition to, we've always done video calls and conference calls anyway, so it's not a new thing for us. And we've found probably that a lot of the corporates and the management teams almost have more time at the moment because they're also not out visiting their global operations, or they're not out visiting investors. So we've found the access to be really good. We've always had very good access. I think the nature of our long-only, long-term, quality-focused style means that companies want us on the register, but they've got more time. And I think in terms of our engagement, as you said, I mean, we're typically doing 500 plus meetings a year. And I think in the first half, we're actually tracking well ahead of our normal run rate, just because, partly because of the environment we're in, means that we've had a lot of calls to fully understand the ramifications of COVID and that sort of thing. But in terms of, our engagement, we don't think it's changed at all. And, we think our historical track record of meeting these companies, holds us in really good stead going forward.
Well, again, thanks, Joel and Ned. And in the interest of time, we might wrap it up there. We're 2 minutes behind schedule, but I'd just like to thank everyone for attending the webinar today with Ned and Joel. Our details are there below if you do need to reach out. We do have a number of questions that have remained unanswered, and we will get back to you. But I'd just like to say thank you for your time, and we'll be in touch, and stay safe. Thank you.
Thanks.
Thanks, everyone.